The markets are currently closed, and Opendoor Technologies Inc., trading under the ticker symbol OPEN on the NASDAQ, ended the last trading session at exactly $6.68. That represents a significant intraday surge of $0.52, climbing 8.49% in a single session that has left many retail traders and institutional analysts scrambling to readjust their models. If you are looking at your Robinhood app or checking the charts on your Fidelity trading platform this weekend, that green candle stands out like a beacon, but the raw number is arguably the least interesting part of this story. What we are witnessing right now with Opendoor is not just a standard volatility swing or a technical bounce off a support level. It is a fundamental dislocation between what the street thinks this company is and what the smart money, specifically the quantitative giants like D.E. Shaw, are beginning to realize it might be. The expectation for Opendoor has long been that of a zombie company, a leftover artifact from the zero-interest rate environment that tried to algorithmically flip houses and got crushed when the housing cycle turned. The prevailing narrative, the one you will hear if you watch standard financial news or scroll through basic investing sites, is that Opendoor is a distressed asset effectively at the mercy of the Federal Reserve's interest rate policy. They believe that until mortgage rates collapse, this stock is dead money. That is the expectation. The reality, however, is substantially more complex and far more explosive. The reality is that Opendoor is currently executing one of the most aggressive corporate maneuvers we have seen in the mid-cap space in years, a shareholder-first dividend in the form of tradable warrants designed specifically to inflict maximum pain on short sellers. This is not just a housing play anymore. It is a financial engineering battleground. When you see a stock jump nearly 9% on a Friday, you have to look beneath the surface. This movement is being fueled by a combination of renewed institutional interest, evidenced by D.E. Shaw's massive 6.4% stake disclosure and the mechanical pressure of this warrant issuance. Short sellers, who have piled into this trade betting on bankruptcy or stagnation, are now facing a scenario where they are liable for these warrants, effectively forcing them to cover their positions or bleed capital. This creates a curiosity loop that demands we look closer. Is this company a fundamental turnaround story, or is this a temporary squeeze engineered by a management team that knows exactly how to weaponize market structure? To understand the gravity of this move, we have to strip away the noise and look at the mechanics of the stock market itself. Most people who engage in online investing or use Schwab Intelligent Portfolios for passive growth rarely encounter the visceral mechanics of a short squeeze, but that is precisely the setup forming here. When you short a stock like Tesla stock or Apple stock, you are borrowing shares to sell them, hoping to buy them back cheaper. But when that company issues a dividend, in this case a complex warrant, the borrower of the share is responsible for paying that dividend to the lender. By issuing warrants instead of cash, Opendoor has created a liquidity nightmare for bears. They can't just pay cash, they have to deal with a derivative instrument. This is a level of 4D chess that sets Opendoor apart from your standard distressed tech stock. It signals that the new management, led by Kasnediatyan, is not just trying to sell houses. They are trying to break the thesis of their detractors. This is why you're seeing that 8.49% jump. It's the sound of risk models blowing up in hedge funds that thought this was an easy short. Let's pause for a moment and talk about the actual business, because the disparity between the stock price action and the operational reality is where the opportunity lies for the individual brokerage account holder. Opendoor's core business model is iBuying, instant buying. They use algorithms to value homes, make cash offers to sellers, do light repairs, and put them back on the market. In 2021, this felt like the future. In 2023 and 2024, it felt like a bankruptcy machine. The criticism was valid. Holding billions of dollars in real estate inventory when prices are falling is a recipe for disaster. However, the Opendoor of late 2025 is a leaner, more terrifyingly efficient animal. They have slashed their cost structure, and more importantly, they have effectively refounded the company as a software and AI enterprise. They are no longer just trying to be a massive landlord. They are trying to be the definitive data layer for residential real estate. The market is pricing them like a reckless house flipper, but they are operating like a logistics and data arbitrage firm. If they can successfully transition their valuation multiple from that of a real estate holding company to that of a software company, the upside potential is not 20 or 30%, it's multiples of the current price. This brings us to the macro environment, which has been the primary headwind for the stock. The housing market has been in a deep freeze. Sellers are locked in by the golden handcuffs of 3% mortgages they secured years ago, refusing to sell and trade up to a 6 or 7% rate. This lack of inventory usually kills volume-based businesses like Opendoor. However, we are seeing early signs of a thaw. As the Federal Reserve signals a more dovish stance and bond yields compress, the spread between buyer affordability and seller expectations is narrowing. Opendoor thrives in a liquid market, regardless if prices are skyrocketing or just stable. They need transactions, not necessarily bubbles. The recent price action suggests that the market is sniffing out a volume recovery in 2026. If you are sitting there with your SoFi Invest account or managing your own Fidelity IRAs, you have to ask yourself if you believe the housing freeze will last forever. If the answer is no, then Opendoor is trading at a valuation that implies a permanent winter, which is a statistical improbability. We must also consider the role of retail sentiment in this recent surge. While Nvidia stock dominates the headlines for AI, Opendoor has quietly regained its status as a battleground stock on social media platforms. It's not just about the fundamentals, it's about the narrative. The retail crowd, often trading through Robinhood crypto accounts or Webull, loves a good underdog story, especially one with a CEO who openly antagonizes short sellers. This creates a floor for the stock price that fundamental analysis often misses. When a stock becomes a vehicle for expression, a way to bet against the establishment shorts, valuations can disconnect from reality for extended periods. We saw it with GameStop, we saw it with Carvana, and we're seeing the early tremors of it with Opendoor. The difference here is that Opendoor actually provides a service that solves a massive pain point. Selling a home is traditionally a terrible, stressful, opaque process. If they can fix that while fighting off the shorts, the stock becomes a dual-threat asset. Speaking of assets, I want to hear from you directly. This is a polarizing stock, and everyone has a different take on the housing market. Comment below how many shares of Opendoor you currently hold, or if you think the housing market is going to crash again before it recovers. I want to see the sentiment in the comments section. Are you bullish on the Amazon of real estate thesis, or do you think this is a dead cat bounce? Now, let's look at the competitive landscape, because Opendoor doesn't exist in a vacuum. You have Zillow, which famously exited the iBuying business because they couldn't make the algorithms work. That failure is often cited as proof that Opendoor cannot succeed, but I would argue the opposite. Zillow's exit left Opendoor as the undisputed category king. They have the data advantage now. While Zillow went back to being a media company selling ads to realtors, Opendoor stayed in the trenches, refining their pricing engines and operational logistics. This is similar to how Tesla stock was doubted for years, while legacy automakers sat on the sidelines, only to realize later they were a decade behind in EV infrastructure. Opendoor is building the physical and digital infrastructure to trade homes online. Whether you use interactive brokers trading platforms for advanced analysis or a simple SoFi robo-advisor, you know that being the first mover with the most data is a defensible moat. The question is whether they can survive the cash burn long enough to widen that moat. The involvement of D.E. Shaw is a critical piece of this puzzle that cannot be overstated. We are talking about one of the most sophisticated quantitative hedge funds in the world. They don't buy 6% of a company on a whim or because they like the CEO's tweets. They buy because their models see a discrepancy in value. They might be seeing that the warrant dividend will force a mechanical squeeze, or they might be seeing that the company's cash position is sufficient to weather the storm while competitors starve. When a fund like that steps in, it provides a layer of validation that retail investors cannot generate on their own. It signals to other institutional capital, perhaps those managing Fidelity mutual funds or Fidelity wealth management portfolios, that the risk-reward profile has shifted. It forces the market to take the bankruptcy risk off the table for the near term, which automatically reprices the equity higher. Let's discuss the risks, because ignoring them would be malpractice. The biggest risk to Opendoor remains a prolonged, deep recession where housing liquidity dries up completely. If people stop losing jobs and forced selling occurs, Opendoor could get caught holding falling knives, inventory that depreciates faster than they can offload it. This is the inventory risk that bears harp on. Furthermore, the warrant issuance, while clever, is a double-edged sword. If the stock price does not perform, those warrants could expire worthless, angering the very shareholder base they are trying to court. It's a high-stakes poker game. Additionally, there is the risk of regulatory scrutiny. The iBuying model disrupts a very old, very powerful industry of real estate agents and brokers.